Greg Parker here from Parker's Property Sourcing. Just coming at you with another video today. Today's video is the truth behind UK property market shifts, and I'm going to give you a current market overview. We're going to see and unpack what is happening in the UK property market, why these shifts are taking place, and what they mean for buyers and investors moving forward in 2026. For me, and in this video, the goal is to separate the noise from the data. And I really want to highlight the real structural changes that are happening at the moment and provide more of a balanced outlook, supported by evidence that I've researched to put this video together. So really hope you enjoyed this video. Let's get into it. So the UK housing market has definitely cooled significantly following the rapid growth that we had around the pandemic years. So by late 2025, annual house price growth had slowed dramatically, almost down to zero levels, with some regions recording month-on-month declines. Not all regions, but some regions. A major driver behind the slowdown, I would say, is the reduced transaction activity. And, the high borrowing costs has really discouraged both first-time buyers and leveraged investors, resulting in, fewer completed sales. It's just, I can see it happening. Lots of landlords and investors have spoke about it. That's what's really declined the market. The beginning of last year, there was lots of sales and stuff going through, but the back end of last year, we really started to see a decline in sales. But I would say the slowdown does not necessarily indicate a crash. Rather, it reflects a rebalancing of supply, rebalancing of demand, and also a rebalancing of affordability. So more people can, re-enter the market. So for me, one of the most important dynamics in the current market is regional divergence. So London has weakened a lot more than the rest of the country has. And I would say that's because of the high entry prices that London always offers, basically, and stretched affordability, in some cases increase landlord exits as well. So a lot of landlords in London have started to exit because it's almost unaffordable. It doesn't make as much sense, In contrast, regions such as up north, northwest, northeast, Yorkshire, and parts of Scotland have shown greater resilience, massive resilience. These areas offer lower capital entry costs, stronger return on investments, like massive return on investments, and growing local demand. So what I'm seeing is the investors that are seeking good return on investment, like myself, like yourself, if you're watching this video, over capital appreciation, they are increasingly targeting the areas up north now, more so than they would be down south in London, more specifically. So what's my forecast for 2026? I would say stabilization rather than sharp rises or massive declines in the market. I think it's going to be really stable for 2026. I'm predicting modest price growths in the range of 1 to 3% over the year. This is based on research and data that I've looked up. But it's important to understand that this forecast is based on the assumption that borrowing costs will gradually decline, which we're starting to see slowly. And then, as I've said previously, when borrowing costs start to decline, buyer confidence starts to return, which then the market starts to pick up, but gradually, not dramatically. So the outlook doesn't, point to a boom. Instead, it just signals more of a sustainable and balanced property market environment, which makes me feel a lot more comfortable as well, to be fair. So let's have a little talk about mortgage and affordability pressures. For much of 2024 and 2025, mortgage rates remained quite high, and it was putting significant pressure on affordability as buyers of home buyers and also as investors. So this led to reduction of transaction across both residential and buy-to-let segments. However, with the expectation of the future rate cuts, affordability may gradually improve, which will reopen the market for a segment of buyers who have been waiting on the sidelines, waiting for interest rates to drop, which is pretty smart. If you're in a position to wait, you'd like to borrow money on a lesser interest rate than a higher one. It just makes financial sense. But despite all of this, first-time buyers continue to face challenges, including high deposit requirements and limited suitable stock for them. So that's something to be mindful of. So with the rental market, unlike the sales market, I would say the rental sector over the last few years has remained very strong. Rent levels have continued to rise across many regions due to the constrained supply and also the sustained tenant demand. So, as always, London remains the most expensive rental market, driven by employment patterns, urban demand, and limited affordable housing stock. But even I invest up north. That's showed a steady growth as well. The rental market very, very strong. So for me, the rental market is still in a very, very strong, good, positive position. Looking forward, rental growth is expected to be moderate as supply gradually improves and tenant demand becomes more stable. So what I mean by that is what I said in the previous slides, that once interest rates start dipping, buyers' confidence start coming back in, there's going to be more, for renters to choose from. There's going to be more stock on the market for renters to choose from, but all nice and stable, and the rental market is always going to be strong. So policy and structural shifts has been massive for landlords, UK landlords. All the changes and the policies that have come in have really shaken up, the landlord sector, and a lot of landlords are selling up. They don't want nothing to do with it. The accidental landlords don't want nothing to do with it. So, recent rental reforms, all the recent rental reforms have altered tenancy rules, increased compliance, and, lots of obligations for landlords in the UK. And in addition to that as well, the tax policy changes have reduced, your return on your investments, especially if you're a highly leveraged investor. You're going to really struggle. So it's definitely prompted quite a few landlords to exit the sector entirely. And it has contributed to reduced rental supply in certain markets, especially in London. Investors who remain active are increasingly, like myself, we're starting to adapt and focus on return on investment, being professional, managing things professionally, being compliant with everything. And I can see, I've always treated my portfolio as a business, but I can see a lot of other landlords now treating their portfolio as businesses, because you have to be compliant. You have to make sure that you've got every legal requirement ready, because the changes are imminent and the councils are throwing out fines left, right, and centre. So for me and for my fellow people that are in property, that are my friends, we're ready. We're compliant, and we're very optimistic. But there are quite a lot of landlords that are exiting and don't want nothing to do with it, So I would say that these market dynamics create both challenges but also opportunities. The stabilisation and cooling price growth may offer entry points for investors who previously found the market overheated. So that's a positive. In the current environment, the strategies oriented towards high return on investments as opposed to short-term capital gains are performing more reliably. Me, if you don't know already, that's how I'm building my portfolio. I'm building it on long-term capital growth, but return on my investment on a monthly basis, so it can give me cash flow. Assets over liabilities, basically. That's the way I'm building my portfolio. So it's kind of falling into my plan, the way things have started to map out. But there are some landlords that it hasn't. And finally, on that point, geographic selection is more important than ever. So what I mean by that is we've got to look at, when we're investing now, we've got to look at areas with good employment infrastructure, affordability, rental affordability and buying affordability. And those two things will really determine your overall returns. It's really, really important to start looking at things in that way. So just to conclude this video, I would say the UK property market is undergoing, I would say, a recalibration rather than a crash. Growth has definitely slowed at the back end of last year, but underlying demand really remains present in today's market. There's a clear divergence between London and more affordable regions. I don't invest in London, but I invest in the more affordable regions. And investors have to start thinking about accounting for the shift when making these decisions. It's so important. The most successful strategies will be those that are return on investment focused, I would say, as opposed to quick capital gains now. And return on investment focus means you've got to be really careful in what regions that you're investing in. You've got to invest in the high demand rental areas with good, stable capital growth over a long term, which is also affordable for renters to rent. That's the strategy. That's the way to be thinking, So really hope you've enjoyed today's video. I've been Craig Parker. Till next time.